I just thought it'd be kind of fun to show you what these quizzes are like and link you to Investor.gov because it's such a wonderful free tool to learn about investing that I wanted to highlight it. Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for self-employed people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're a creative or soul-centered entrepreneur or wellness practitioner who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your time and have a bigger impact with your work, you are in the right place. Hello. So happy to be with you today. I just sent my girls off to their first day of school today. So to those of you out there, parents, with those first day of school happening, I feel you. It's such an emotional moment, isn't it? And some of you, the wonderful childless cat ladies among you, I hope you enjoy doing whatever it is that you want to do in the morning. That is one of the delightful things, I assume, of not having a kid, which I say with deep affection. You know, my brother does not have kids, he and his husband. Honestly, they are living the most cool and exciting life. And I think like, that looks pretty damn good. Of course, you know, I've made my choice and my girls are a lot to me. Anyway, today, what I want to talk to you about is investing and investment fees. So I was thinking about planning today's episode and like, okay, Hannah, are you really going to just like talk about fees on investments and just like recite a bunch of numbers to people? This is not going to be a really fun episode to listen to. And I think that may be true. So I want to just give you a little bit more of the overview of why you need to pay attention to fees when you begin investing for the first time and what fees can look like. So I'll try to keep that part brief, but I thought I would do something kind of fun and actually kind of as a way to highlight an incredible tool that your tax dollars fund that is free, which is an incredibly great resource for learning the basics of investing, learning how to spot a scam, learning how to start investing with your teenager, you know, crypto scams. Like, it is such a comprehensive and wonderful resource. And it's a resource I use all the freaking time because it has a wonderful compound interest calculator. So what I'm talking about here is the Securities and Exchange Commission has a website called Investor.gov. This is a government website. This is your tax dollars at work. It's free. And it's a place where you can look up advisors you may want to hire. You can see if they have any, you know, fraud or complaints against them. Highly recommend you do that. There's lots of different calculators available on this site. There's a savings goal calculator, a college savings calculator, a required minimum distribution calculator, and the one that I use just all the time, over and over, including as a method of procrastination, because I just find it fun, compound interest calculator. So let me start with a quick kind of rundown about fees and what you need to think about, you need to consider when it comes to fees. And then let me walk you through a quiz available on Investor.gov. There are lots of different quizzes on Investor.gov where you can test your financial knowledge, your knowledge about investments, and they're awesome. They're really, really awesome. And they show you places where you might not know all the things that you think you know. I just spent the morning doing several of the quizzes on here, and I will tell you, I did not get every answer right because, you know, they were bringing up types of accounts that I didn't know about, or, you know, they had little details about like the way that the Securities and Exchange Commission works that I wasn't aware of those details. So these quizzes are really, really good. And of course, you know, you can do them in the privacy of your home. Nobody ever has to know that you got a wrong answer unless you announce it on a podcast. So let's talk about fees really quick. So something that's really important to understand when you invest, and Now, listen, a complete investment portfolio should be diversified. This is one of the pillars of investing. You do not want to put all of your eggs into one basket. You want to mitigate the risk. There's real risk when it comes to investing of losing money. And to mitigate that risk, you want to have diversification. Diversification just means you're kind of putting some of your money in several different spots, right? So that might look like some equities. You might know those as stocks, some bonds, also could be some real estate holdings. You don't necessarily have to go out and buy a house or an apartment building to invest in real estate. There's ways to do that through, investment products like REITs. But so there's different ways to diversify, and you can be diversified even within those categories. So for example, if you are investing in stocks, and I do not think that picking stocks is an investment strategy. I think people should not do that. Just period, end of sentence. And P.S., nothing I say today is investment advice. Yeah, it just isn't. So you have to do your own due diligence. But I just want to kind of talk to you and educate you about kind of what's out there, right? So, for example, a way that you might, I invest in primarily index funds. Mostly those are stocks. There are index funds that are bonds as well. Because I'm relatively young and have quite a long time horizon, my portfolio is a little geared more towards stocks. I'm looking for growth, but I do have some diversification in terms of bonds in there. But even within my index funds, I have diversification there. So I have US stocks, and I have global stocks, and I have what's called large cap. That basically just means like big companies, large capitalization. In other words, these are companies with a lot of money. And mid cap and small cap. Small cap is small business. And when we say small in this context, small is pretty big, right? Small is not like sunlight tax. I would be like micro. So one of the things that's really important to keep in mind essentially is that most investors never beat the stock market, right? People will point out when they beat the stock market, and of course you can beat the stock market, roughly 50% of the time. And what is that? If anybody here ever took statistics or just a basic coin flip study in science class, 50% of the time is chance. In other words, you're not beating the market. So most people don't beat the market, which is why, for me personally, I really believe in just buying the market. So buying an index fund, buying into indexes, which just track the market itself. In other words, when you're investing through index funds, you're buying a whole box of investments all at one time, a representative slice of every single fund available on an index, like the S&P 500, for example, which is one of my favorites. You're buying the whole thing. So in other words, think of it as buying the whole market. You're buying, instead of trying to search for and find the needles in the haystack, you're buying the whole haystack. The needles are in there. You don't have to pick them. You're just going to get the benefit of them because they're inside what you have, right? So, if you've ever looked at companies that have blown up in value, like, I don't know, Nvidia, for example, and thought, oh, I wish I'd been in on that. I comfort myself saying like, listen, I didn't have the power to ever pick that stock, nor would I. I don't believe investing that way. But because I've been invested in the S&P 500, I own Nvidia. I have benefited from that rise in Nvidia stock. Okay. And you might too if you owned some basic index funds. So there. Okay. But the thing to keep in mind, essentially, a sort of agreed upon rate of return. People can quibble with this, but let's just pick a number so I can teach from there. A pretty well accepted rate of return when you have money invested in stocks is 8%. And here's how I want you to think of fees. Fees are the enemy to your investment returns, okay? Fees are the enemy. And not only that, 8% return on your investment is the ceiling on the returns you can get on your investments. That's the highest investment you can get. And that's in theory if you are paying no fees. Now, investment fees, especially to a beginning investor, they look really small. We're talking about, theoretically kind of small looking numbers like, an index fund fee, which we call an expense ratio. So the expense of a particular, stock index ETF is called an expense ratio. This is something you should always check before making an investment. You want to check what your expense ratio is. That means you're checking the fee. How much does it cost to be invested in this? It's very important. A nice low expense ratio might be 0.15%. That would be a good fee for an index fund. That's about as low as you can get. Now, fees go up from there. And once you start, and there are some index funds that charge more than that, and you should be careful and shop around and look at those fees. Okay. Some products like mutual funds tend to have much higher fees. First of all, mutual funds tend to be actively managed, meaning you're actually paying somebody who is picking the basket of stocks. You're not buying a whole, an index fund can have much lower fees because it's just a representative slice of the market. There's no sort of greater intelligence behind it picking things. It just is the whole market. A mutual fund, somebody's back there picking it and you're paying them and you're paying for their, you're paying them. So those fees tend to be much, much, much higher. Mutual fund fees can be, as high as 1.5%. Now that might not seem like a lot, but think about it. If 8% is the ceiling, if 8% compounded annual is your maximum rate of return, that 1.5% is subtracted off your 8% return, right? So you would only be getting a 6.5% rate of return. And so once you multiply those fees times compound interest over the long time horizon, that is what investing is all about, you're going to see that a fee that looks, quote, small, like 1.5%, is actually enormous. Okay. That's the kind of key takeaway. I don't want to overwhelm you with information today. I kind of threw a lot at you really quickly right there, but that's the basic way that I want you to think of it. So I don't want to overwhelm you with information. I just threw a lot at you, but I want you to just think about that concept of 8% compound annual return being a pretty, respectable, generally agreed upon maximum rate of return on your investments, and every fee you have as coming off that 8%. So I just want to give you a concrete example of what a 1% fee looks like over the lifetime of an investment, because 1% sounds tiny, right? But I want to show you how 1% is actually not tiny at all. Okay, so let's compare here. I like using numbers that connect it to that annual habit I hope I've taught you to have, which is to max out your IRA. Doesn't matter if it's Roth or traditional. You can fuss over that. We could talk about when to fuss over that, but just one or the other, the limit is the same for both. So the current year maximum amount you can put into a Roth or traditional IRA is $6,500. And you need to, once the money's in there, you're not done. You need to take the money that's inside your IRA and put it into investments. That is part of the key of building your nest egg, of having that retirement savings. So that money must get invested. So you can't avoid this. You must invest your IRA. So I'm using $6,500, the current year max, as the initial investment. And I am plugging this into the compound interest calculator that you can find on Investor.gov. I will link to it in the show notes. This is like my hands down favorite financial tool out there in the world, and it's free. So play with it all you want. I love it, love it, love it. Get to know it, nerd out on compound interest. There's nothing more fun to me. Okay, but just to give you an example, I put an initial investment of the max of an IRA, $6,500. P.S. If you're over 50, you can bump that up $1,000. You have a catch-up contribution. But for anyone under that age, $6,500. And I'm adding a monthly contribution of $542, which is just $6,500 divided by 12. So in other words, that is just how much you're contributing each month in order to max out an IRA. So I put in a time span of 50 years. I realized that for a lot of us, we don't have 50 years of life left, myself included there. But I put that in because, you might be 19 listening to this show. And if you are, oh my goodness, what you can do just maxing out your IRA for your entire career, it will be amazing. So let's look. Over 50 years, assuming an 8% annual compound interest, your $6,500 per year, your Roth contribution invested in a basket of diversified stocks becomes $4 million and some change, but I'm gonna round off here. So it becomes $4 million. I mean, the cool part is your lifetime contributions are only $330,000, and it grows through, this is the power of compound interest. It grows, your $300,000 contribution becomes $4 million through the tremendous power of 8% compound annual interest. Okay. That's the power of compound interest right there. So what I've shown you there is basically the max, right? You're not going to do better than 8%. You might in 1 year, and then the next year you won't. I mean, investing is a long-term thing, and some years will be better and some years will be worse. And yes, you can lose money in the short term, no question. But averaging out the rate, we say it's 8%. So $4 million. Now, that's with no fees. Now I want you to take a look at what it looks like when you have a 7% rate of return. Okay. So in other words, a 1% fee, right? So if this whole thing, and I'm not saying you should do this, don't put all your eggs in one basket, but if you had, just for comparison purposes, and you had a 1%, you put your money into, for example, a mutual fund with a 1% fee, we would call that an expense ratio of 1%, which is certainly something that is possible with some mutual funds. Then your return over 50 years, same amount invested per year, would be $2,800,000. Okay. So 2.8 million versus 4 million. In other words, a 1% fee cost you $1.2 million over the lifetime of your investment. It reduced your investment. Let me just do the math here for you. It reduced your returns by 30%. You have 30% less money over the lifetime of your investment than you would have if you had not had a 1% fee. So I just want to express to you that is how powerful your fees are, and they are your enemy. They are in direct opposition to getting a return on your investment. So if you hear nothing else, I want you to just take away the gospel here, which is fees are the enemy. You want your fees to stay as low as possible. And a thing that is powerful for you is that every bit of education you can give yourself, every investment you make into, and I don't mean a financial investment here. It could be, for example, like buying a book on investing, right? Like that, sure, $20. But it could just be the time to read that book. P.S. You can get books at the library. It could be the time to read that book. Certainly time spent on Investor.gov doing the quizzes and reading up about investing principles. There's it's a really well done site that's really helpful. So any investment of time you make into learning how to invest for yourself is going to give you more control over the way you make your investments. And honestly, you can do it yourself. You do not need to be paying advisors who take fees out of your long-term returns. Okay. And I also want you to be aware that choosing the funds you invest into and looking at those fees before you buy is critically important to your lifetime return on investment. Okay. We're talking about getting your money to work for you while you're sleeping. Just do the upfront work of buying the fund that has the lower fee. Okay. That's kind of the key. All right. So let me just for fun, I thought we would go through one. It's just a 10-question quiz available on Investor.gov. You'll see that it's got some easy questions and some harder questions. I just thought it'd be kind of fun to show you what these quizzes are like and link you to Investor.gov because it's such a wonderful free tool to learn about investing that I wanted to highlight it. Okay. So here is the August 2024 investing quiz available on Investor.gov. You can do it with me. All right. Question 1. Day trading is a long-term investment strategy. True or false? Follow along at home. Question 2. Buying a single company stock usually provides a riskier return than purchasing a stock fund, such as an exchange-traded fund or mutual fund. True or false? Question 3, anyone can check the background of an investment professional on Investor.gov. True or false? Question 4, a margin account is a type of brokerage account in which your broker lends you cash to purchase stocks and other securities. Margin accounts may increase your purchasing power, but also expose you to the potential for significant losses. I will admit to you, that's the one I wasn't aware of. I didn't know about those kinds of accounts. It's the kind of thing I avoid like the plague, but I've now read up on them. Question 5. Contributions to a Roth individual retirement account, IRA, are made with after-tax funds and are not tax deductible, but earnings and withdrawals are tax-free. True or false? For those of you who are longtime Sunlight listeners, I really hope you know the answer to this one. I try to talk about it a lot. Question 6. An emergency fund can help pay for which of the following unexpected expenses? A cracked screen on your phone, car repair, family crisis, or all of these? I hope you've heard me talk about emergency funds. I did an episode just recently about that. Question 7. If you lost money or crypto assets due to a bankruptcy or a scam, fraudsters may target you for another scam. True or false? Question 8. Riley's investment account has $10,000 in value. If Riley's investment account earns an average annual investment return of 7% over the next 10 years, the total value of Riley's investment account will be approximately $10,700, $17,000, $20,000, or $34,000. Now, you might think that it's impossible to just know off the top of your head what a rate of return you might get given that initial value and the percent rate of return. But here's the thing that is working in the background here that I want you to know about. Compound interest has a doubling rate. So depending on what percentage of compound interest you have, your money will double in X number of years. I happen to know off the top of my head that if you have a compound interest rate of 8%, that your money doubles every 9 years. So I know that at a rate of 7%, your money is going to double in greater than 9 years, right? So I actually got the right answer just because I know that baseline rule. But that knowing little rules of thumb like that can be very helpful to spot things and estimate things as you make decisions about your investments. And I just want to say, if you're new to this world and you're feeling intimidated, and trust me, I started 15 years later than I should have because I felt so intimidated by this stuff. And now I'm pretty comfortable with it. So I want to speak to you from the other side of that divide and say you really can do it. This is a free tool. Investor.gov is a wonderful way to learn about investing, and it will teach you some of those rules of thumb, like the doubling rate of compound interest. So you could nail this question if you knew that rule of thumb was there, and that's kind of what they're getting at when they ask it. All right, so onward. Question 9. What is the main advantage that index funds have when compared to actively managed funds? Index funds are generally less risky in the short term. Index funds are generally less likely to decline in value. Index funds often guarantee a specific rate of return, or index funds generally have lower fees and expenses. I talked about fees earlier in this episode, so that answer is out there if you were paying attention in the last 10 minutes. All right, so that's the end of, there's one more question. Fraudsters, question 10, fraudsters may initiate contact with victims on social media platforms or through unsolicited text messages. True or false? All right. So when you do this quiz, I'm going to put the link to this investment quiz in the show notes so you can go through and check your answers. I don't want to take more of your time by reading through all the answers here, but if you're curious about any of those things, I encourage you to come through and do this quiz yourself and read the answers at the end. I'm really trying to highlight this wonderful government service that you have available to you that is free, that's paid for with your tax dollars, and it's really good. It's good and it's kind of fun. And if you're on a boring Zoom meeting, this is a great way to pass your time. All right. So I hope this episode has been helpful to all of you. I am going to link to this quiz on Investor.gov, and I'm going to link to the compound interest calculator on Investor.gov. And my hope is that you'll take advantage. Take a look at the site, bookmark it, play around with compound interest yourself, learn a little bit more about fees and index funds. I really encourage you to do that. All right. And the last thing I want to say is, in just a couple days, I'm hosting an open house for my program, Money Bootcamp. So if you're new to this podcast, my signature program is called Money Bootcamp. It is where I teach you how to handle your freelance taxes, set up some simple systems to keep things easy. I have a live session where I teach you about quarterly tax payments to help you make your calculation for quarterly taxes. And I also teach you about investing and all of the tax advantage accounts that you can invest through that grow your money faster, that keep that 8%, keep your investment returns closer to that 8% and not lower. So if you're interested in my program and just learning about it, this open house is not a sales pitch. It is just a place for you to see inside and ask me questions about the program. It's not a place to come to ask me tax questions that are your tax questions. That's a service I provide and I'm happy to provide. That's a paid service, but it is a place to come see inside the program, ask me questions about the program, whether it might be a fit for you, anything you're curious about, I'm happy to show you inside the open house. So that open house is definitely free. There's no pitch. It's a really great, low key session. You do have to register. So I will also put the registration link to my open house in the show notes, and I hope to see you there. That is this Thursday, so just in 2 days. All right. Great to join you today. Thanks for joining me, and I will see you next week. Bye. Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.